Welcome back to Year 12 Business Studies, where we're going to move on to financial institutions today and predominantly looking at banks, investment banks, finance companies, super funds, life insurance companies, unit trusts, otherwise known as managed funds, and the Australian Securities Exchange. Okay, so starting off with banks, I think probably the most easily understood and most common form of financial institutions that operate in Australia, remembering that all these financial institutions are considering different places where organisations or businesses such as Qantas could go if they need advice, if they need finance, if they need a place to keep their funds, that their revenue that they're generating, and obviously also a place to pay their costs from. So banks, major type, the most common type of financial institution that pretty much that all organisations would deal with, and you can see our four big banks in Australia across the bottom of the screen: ANZ, NAB, Westpac, and National Australia Bank. They can provide a whole suite of products and services to an organisation, from day-to-day banking to the provision of an overdraft to a mortgage to purchase property, to even advice, and potentially even a place to hold superannuation funds. Okay, to move on to some of the some of the financial institutions which people may not understand quite as well. Firstly, investment banks. Okay, investment banks' predominant role is to provide capital to businesses and advice to businesses. So merchant banks are really the bank to big business. They are there, organisations like Macquarie, like Citibank, like JP Morgan. They operate to provide advice to businesses, and they're experts in providing advice. And that advice might be around different sources of capital that business should acquire or should seek to get access to. It might be advice around the acquisition of a competitor. It might be advice a business might go to an investment bank seeking help with the future of their business. Should we look to acquire? What can we do to try to grow our business? And the experts at that investment bank will give them some direction and try to answer those questions. They can also offer funding, so in the form of short and long-term loans. One thing an investment bank can't do is hold funds on deposit. They don't have banking licenses to do that. Therefore, they are not a day-to-day bank where you can transact on a regular basis. They can provide financing for businesses, or they can help to arrange financing for businesses. And when we're looking at equity as a form of external finance, things like rights issues, placements, they are often done with the help of an investment bank, probably in conjunction with a stockbroker. But an investment bank may well advise on the best way to undertake a rights issue, for example. So they're predominantly there to offer advice to business. Okay, finance companies, another form of financial institutions which could help a business. They generally can offer short and long-term loans. Again, like our big four banks, they're not licensed to hold deposits, but they are licensed to be able to lend out money. And again, some examples across the bottom of the screen there in the form of GE Money, Rent.com.au, and Asanda. Businesses must pay to compensate the finance company for the additional risk that they take on, and finance companies often will be there to help the smaller businesses, probably more than the larger businesses, because they can't access as much capital that the larger businesses, such as Qantas, such as Macquarie Bank, such as BHP, they might require. Often those finance companies are charging a high rate of interest when they're lending capital. That's for a couple of reasons. Number one, they're generally lending to businesses that have a higher risk. And secondly, because they can't hold funds on deposit, they need to source their funding from other sources other than money that's there in people's savings accounts. They may also provide lease finance to businesses, or even potentially factoring of debtors. So a factoring firm would fall under the auspices of a finance company. Super funds are a big source of capital in Australia, and increasingly so, because of the compulsory contribution that people must make in their superannuation funds. So in Australia, every person, unless they're self-employed, must have 9.5% of their pay contributed to their superannuation. And as a result, there is billions of dollars sitting in superannuation funds which needs to be invested somewhere. And that capital then can be invested in things like shares, potentially in big buildings. Cbus that's on the bottom of the screen there. They predominantly use a lot of their superannuation funds that is invested with them to build buildings. And I think they've actually recently completed a large office tower in Sydney's CBD. They also invest in shares to a large degree. They might invest also in government and corporate bonds. So they are a very important financial institution and are a significant source of capital for a lot of public companies and also for infrastructure related or debt related business activity. Life insurance companies, they are companies that collect premiums from people who are seeking life insurance, so insurance obviously on their life, and then that money is often reinvested somewhere else to try to make that life insurance company a profit, and also to make sure they have money available to be able to pay out if people do need to claim on their life insurance. So they may well invest the premiums that they're collecting from people in shares or in some other investment to try to grow that money. You can see some examples there: ING, AMP, CommInsure. They might be some companies that you're familiar with or you have heard of that are life insurance companies. Okay, unit trust. I said earlier that a unit trust we really refer to them here as managed funds. Examples there: Colonial, BT, Perpetual. They are prominent unit trusts here in Australia, and they are fund managers operating on behalf of their clients, where they pull together a lot of finance from a range of people, or money from a range of people, bring all that capital together and invest it on those investors' behalf. Often it's superannuation money, or often it's just people's private investment. And so they will go and invest in things, again, like shares, direct property, listed property, so real estate investment trusts, or they might just invest it in cash in an effort to try to increase the value of that money that they've been given by those investors. Finally, in terms of financial institutions, is the body that oversees the stock exchange, or the securities exchange, I should say, and that's the ASX, so the Australian Securities Exchange, once previously known as the Stock Exchange, but when they merged with the Sydney Futures Exchange, I think it was around 2007, they became the Australian Securities Exchange. And their job is to oversee the successful running of the Securities Exchange and making sure that the companies who have their shares listed on the Securities Exchange, that they're happy with how that's occurring and that it's an efficient market. It's a very important part of our economy, the Australian Securities Exchange. It's allowing capital to flow from investors to companies who can then use that to try to grow their business and also in return to pay dividends back to those shareholders. That's it for financial institutions, and next video will be on the influence of government. Here's just a little bit of extra information for the ASX.